Good morning and welcome to this session of the live learning classes conducted by the Board of Studies of the Institute of Chartered Accountants of India. So usually we meet in the evenings and today we are meeting in the morning, possibly the better time for studying in the mornings, that was in early mornings. Good morning once again and thanks to all those of you who've greeted me here. Shankaran is here from Nellore. Vanakkam sir and others. Diksha, Rajini is here, Jaspreet, Bhumika is here, Aisha is here. Aisha is asking a question. Let me deal with that before I proceed. See, I think now preliminary and pre-incorporation contracts are not in intermediate. It must have been a very old question paper you are looking at. I don't know. I'm not aware of that part. Because that was the time when I was, at that time it was there in intermediate syllabus, 2007. Pre-incorporation, I think now it's gone into foundation course or whatever, I don't know. But whatever it is, to answer the question, there are two types of contracts, pre-incorporation contracts and preliminary contracts. Pre-incorporation by the name, as the name implies, the contract was entered into by the promoter before the company comes into existence. Please understand, at the time when the contract was entered into, the company was not in existence. Even see, the real question is, are the promoters the agents of the company? No, at the time before incorporation, they are not agent, because for an agent to operate, there should be a principal. The company is not in existence, so there is no principal now. So, which means any pre-incorporation contract entered into by the promoter is done at his risk. Subsequently, after the company is incorporated, at the first board meeting, the directors, if they, on behalf of the company, if they acknowledge the pre-incorporation contract and ratify it, so that once the principal comes into existence, post that, it's only if it is done by the board, it is binding on the company. And again, it will be a novation, meaning a new contract is entered into between the company and the other person upon the same terms as entered into by the promoter. Therefore, all pre-incorporation contracts, the company will not be liable. So, no third party can enforce it on the company. He has to enforce it only on the promoter or whoever it is he contracted with. So, that is why when you are entering into a pre-incorporation contract, you should take care. You should mention that it is being entered into on behalf of a company to be formed. And that on formation, the company would accomplish. Even then, if at the first board meeting, the pre-incorporation contracts are not acknowledged, then they are not binding. See, they don't become void. They are not binding on the company because the company is not a party to it. So that will be the answer. There's a famous case law also, I forget about. So in England, where somebody ordered wine and all for a hotel to be formed. Subsequently, the hotel was formed, but they refused to acknowledge the contract. So whether that can be enforced on the company, they said no. The court said very clearly no. At the time when the contract was entered into, there was no company. Therefore, it is not binding on the company. So that is the answer to your query, madam. Good. So Mr. Akesh is here, Sushil Kumar, Proshita, Tejas, Yajurvedi, Darshan of course is here, Madhav is here. Good show. All of you welcome. So we've made good progress, if I may say so, in this topic, share capital and debentures. And today we are going to go on to the next topic. See, in the last class, before I said goodbye to you yesterday evening, I had spoken about reduction of share capital. And we also saw that reduction of share capital happens when in two circumstances, essentially. One is negative, where the company has incurred so much losses that its net worth is eroded. I gave you a numerical example also. Net worth is eroded and the company's capital is not represented by assets. In that case also, there will be a reduction because to bring it back to reality. So that is called reconstruction. In fact, that is called internal reconstruction. Which is usually the case. Most of the time, when a company goes for a reduction of capital, it will be because it has incurred so much losses that the capital is not represented by assets. I showed you the balance sheet, which had there was a net worth erosion there. The loss is more than the capital. Then debtors, creditors are there. Assets are there, but not sufficient to meet the liabilities. It is an insolvency situation. At the end of the liquidation, even if the assets realize exactly what is stated in the balance sheet without discount, even then, in the example I gave you, there will be a 5 crore insolvency. Means the shareholders will get nothing. Maybe some of the creditors, unsecured creditors, may also lose money, a portion of their money. This is the situation. So that's called unfortunate limited, I called it. In those cases, it will be better for the company to reduce the capital. Instead of bringing it to zero, we'll bring it to 10 paisa. Ideally, we should bring it to zero. But in order to give that, see, tomorrow, if the company is into liquidation, these guys are contributories. So for that purpose only, I'll put it at 10 paisa. That's all, notionally. I will also request some support from the creditors who might reduce their dues and all. This whole process is called reconstruction. It might be a process, part later on in the final exam, you will study compromises, arrangements, and amalgamations. This could be part of that. That's why the word compromise will be used there, where everybody has to compromise. Everybody has to give up. The shareholders will give up. See, after all, he has invested 10 rupees now. That 10 rupees will go off. Another aspect is where the company is having so much money. Maybe the company sold an asset and that capital gain realized in cash is available. Now the company may not require it. So it's in excess of want. It's a overcapitalization. So they may return that money to the shareholders. Instead of giving dividend, they may say, we are giving you back as capital, almost like buyback. So they will say 9 rupees share. 10 rupees share, we'll make it 8 rupees or 5 rupees. The balance 5 rupees nominal value plus your some premium we'll add, valuation we'll put, we'll give it back to you. Take it and go. You continue to be shareholder, but you have got your money back. So there again, we'll reduce it to a small value and keep it there. Okay. So these are 2 examples I gave you. Procedure is fairly simple. You go to the tribunal and get it. Because one more thing is, in the case of partly paid shares, instead of paying back, we might reduce the liability. We might reduce the liability. In which case, we'll say, hey, you don't have to pay this money. We'll make it as fully paid up without you paying this money. That is when you have to be careful. The creditors have a right to object. And if the creditors do not agree, then the reduction cannot go through. Okay. So we saw all that, the right of the creditor who's left out also we saw, etc., etc., etc. So reduction of capital is a general provision. If you want to reduce your balance sheet, you have to go through section 66. Also, as per the accounting standards, if there is a capital reconstruction, there should be clear disclosure in the balance sheet so that any user of the financial statement should be clearly aware that this is a reduced balance sheet. Sometimes in those days, we used to add the words and reduced to the company. Unfortunate limited and reduced. So that this meaning this is a reduced balance sheet. And a detailed note has to be given in the notes on accounts. Idea is to give transparency and disclosure. That is why they are saying the accounting standard should be complied with. That we should confirm that the auditor should give a certificate. Okay, that this has been done. Now, other than 66 and 68, which is an exception to 66. That is, normally if you want to go for reduction of capital, 66. 66 is the route. Creditors, etc., etc. You have to get confirmation from creditors. Notice will be given, no objection, all that process. It's a little long-winded. But suppose a company sees an opportunity and wants to buy back a portion of its share capital. If it complies with the procedure laid down in 68, then it need not comply with 66. So my understanding, and I hope it is yours also, is that 66 is the general provision. 68, buyback of securities, which we will be seeing today, is the exception. So if you are willing to come through 68 puts certain conditions. If you are willing to satisfy those conditions, a portion of your capital, you can buy back. You can do that every year. Every year you can buy back securities. Okay. Provided you comply with 68. But if you're not able to comply with 68 for some reason, then you have no option. You have to go only through 66. Right? Because there is a clear prohibition on purchase by a company of its own shares. Clearly, 67 says, no company shall have the power to purchase its own shares unless the consequent reduction in capital is effected or done. Effected means done in accordance with this act. So please understand, either you go through 66 or you go through 68. 66, reduction, or 68, which is an exception to 66. Either this or that. Other than that, you cannot. Once share capital is credited, it cannot be debited. Share capital account will be debited only in certain circumstances. Of course, at the beginning, forfeiture, share capital debit, but again it will be reissued and credited. Right? Reduction of capital, debit. Once confirmation with tribunal, only then you can debit capital and credit capital reduction account or whatever, capital restructuring account or whatever you are operating. Again, buyback of securities. There again, I will debit share capital. Okay. Any other examples that you can think of when share capital will be debited? Other than this, forfeiture, I debit share capital. Reduction under 66, I will debit share capital. Buyback of securities, equity or preference, I will debit share capital. Redemption of preference shares, then preference share account will be debited. Agreed? Specifically, when I am redeeming preference shares, I will debit preference share capital to preference shareholders account debtor, then preference shareholders account debtor to bank. That is okay. Any other examples where share capital will be debited? Of course, I am leaving out one important item for you to tell. When share capital is debited, I am leaving it for you to think and tell me. One more time it will be debited, or maybe more. But surely one more I have left out. When share capital will be debited. Anybody? Otherwise it cannot be debited. But recently, about 2 years ago, one startup company director, she is an engineer, but she was using Zoho books, and somehow this Zoho books wala has given them a promise that even anybody can use this software. You don't need accounting knowledge to operate my software. Some nonsense they have told, and all these engineers stupidly think that they can maintain books of account in Zoho without chartered accountant or without accounting support. So this lady started maintaining accounts, and she came to us. They came to us from another auditor. Due to many reasons, they came to me. Kavita ji, I already mentioned forfeiture. Maybe you joined a little late. I already mentioned forfeiture. I have already mentioned forfeiture. And I'm not getting many examples from you. I thought immediately Darshan and others will jump in with answers. So I already mentioned forfeiture. Forfeiture is the beginning. First, forfeiture, buyback, reduction under 66, buyback. I have given. Any other? So this lady sends me her accounts. And sorry, before I go into my story again, Bhumika is giving me the right answer. Let us see if more people join and give. Yeah. One last situation is there, na? Antim Divas hai na? When the company is dissolved, or rather the company is being liquidated, and finally you have to pay to the shareholders. I have been a liquidator for about 5 companies. So my job will be over only when I pay money to the liquidator, to the shareholders. So, drawing, Subham, what are you saying? Can you elaborate? One single word drawing is making me worry about whether you have even understood this subject or not. Are you with us, Subham? What is drawing? You are drawing. Who will draw? You mean to say shareholders? Boss, I taught now first session in share capital. The share capital of a company is fixed. No drawing going. It's not a proprietorship or a partnership. Boss, are you clear? Are you able to understand the subject at all? Are you with us? Yes, correct answer is when company is dissolved. No, actually dissolution is the final stage. At the time of liquidation, one last entry I will make. I will pay the money to that shareholder also. And thereafter nothing is remaining. Then only I'll go to the OL, present my accounts. OL will clear it. Then we'll file an application before the tribunal for dissolution. And dissolution. And then at the time of dissolution, then the tribunal will pass an order. From that date, the company is dissolved, meaning its name, you have to inform the registrar. Then the registrar will remove the name of the company. So, debit to share capital will happen before dissolution. It is possibly the last step in liquidation. Once that is over, then I, as the liquidator, will go to the OL and get the records audited by the OL, reviewed by the OL. Then OL will give a certificate to the tribunal. Then I will make a final application to the tribunal saying, my dear tribunal, kindly dissolve this company. So the tribunal, after all, OL has assured them there is nothing more, everything is correct, proper, no fraud, nothing. Then the tribunal pass an order. At that time, the company will be dissolved. Dissolution is the final death. That's it. But this entry will come earlier. Repayment of capital is what? 66 and 68 now. I mentioned it now. Repayment of capital can be done only under two sections, 66, 68. Otherwise, you cannot do any repayment, which I have mentioned already. So the correct answer is dissolution. At that time, actually, even dissolution is wrong. Okay, if you are using the word dissolved, Rajni is using the word dissolved as synonymous with liquidation. I have no dispute with her. But be careful, and dissolution is a special term. Dissolution refers to the actual moment of death. Liquidation is the process of killing. Liquidation is the strangulation process by which the company will be slowly killed. Everything, creditors will be paid, assets will be sold, creditors are paid in the order of sequence. Then finally, preference shareholders are paid. Then finally, what is left, I call the equity, give them. With that, nothing in the balance sheet. Balance sheet zero. Both sides zero. Then only I can go for dissolution. To make the balance sheet both sides zero, final entry will be debit share capital. But here is this engineer, fantastic lady, highly brilliant lady. She gives me Zoho books of account for audit. It's a total mess. Total mess. My audit manager comes to me and says, sir, it's a mess. What do you mean mess? Show me. No, sir. Share capital has been debited, sir. Like that. What do you mean, yeah? Yes, sir. 2.5 crores share capital debited, sir. Like that he told. Neha, what are you telling? Like that I said. Then I called that lady and said, madam, the share capital is debited in your account. How is it possible? She said, as she's a brilliant engineer, she says, Mr. Srikanth, I thought you are a chartered accountant. Don't you know basic accounts now? What is this basic accounts? I'm not aware of. Because already you know I'm very weak in accountancy. I was a little worried. Then she said, Mr. Srikanth, what is the rule of double entry? Debit what comes in? Huh? Share capital is coming in, sir. Like that she is arguing. See, that is the problem with our profession. Any donkey thinks it can do accounting. Huh? It's a specialization, I say. You and I are struggling so hard to become chartered accountant. Imagine, will anybody presume to become a doctor and do the doctor's work? Will anybody presume to build will I presume to build a building, construct a building? Or will I presume to write code and prepare software? Because I'm not an engineer, I won't even presume to do that. Whereas these people think accounting is so easy, Zoho books they can use. And then I told her in no uncertain terms, I sent a mail to the board of directors. Their MD, I said, look here, your accounts are a mess. I cannot audit it. You get it prepared in a proper way with a professional accountant. You choose the accountant. But I cannot audit it. And so, no, sir, we are in a hurry. If you are in a hurry, then beginning itself, we should have hired an accountant. After all, paying a man 25,000 rupees, what you are losing? You are trying to save that money and make a mess. No. So finally, they outsourced it to somebody whom I referred, of course. They don't know anybody. That fellow came and he started laughing at this. Then finally we prepared, and of course accounts are audited properly and all. That is different. And just to tell you, see, these non-accountants, non-chartered accountants or non-accountants, I would say, think, today with the do-it-yourself culture, especially software like Zoho books and all that, they think they can do anything and it's not possible. They only, see, it's a waste of time. Okay. Bhumika is talking about amalgamation. And so, madam, the problem is you are aware of a topic. You are aware of amalgamation, but what you are not aware of is the intricacy of amalgamation. See, in amalgamation, what happens now? It's a good example you're giving, but it's not a separate example. I will show you. In amalgamation, what happens? One or more companies are merged into a transferee company. So these transferor companies now, which are getting merged, these merged entities will be dissolved without winding up. Dissolved without winding up. So at the time of merger of these accounts, absolutely correct. Share capital of this company will be debited, but they will become shareholders in the amalgamated entity. Therefore, strictly, I will not bring amalgamation here. Even if you say, no, sir, amalgamation is there, sir, I will agree, amalgamation is there, but it is only one more branch of liquidation and dissolution. So, the share capital is debited because the amalgamated companies are dissolved without winding up. So, I will debit all the assets, debit all the liabilities, credit all the assets. Then the net amount is there. Now, against that, I will adjust the share capital and allot shares in the merged entity. If my investment is there, then I might lose money also in that. Otherwise, the shareholders of the amalgamating companies will get shares in the amalgamated entity. Even if they, okay, so this is the answer to you, Ms. Bhumika. You are right. Golden rules are never dead. That lady will be, I would have shot that lady. Why? The golden rules of accounting are the pillars on which we build. In fact, any person who wants to join my firm, Karpagam Krishnan and Natarajan, I only ask him one question. I'm not talking about CA inter students or articles, even articleship students. When they come through direct entry and all, the only question I ask them, do you know the 3 rules of double entry? They are able to repeat the 3 rules of double entry and explain to me what it is. That's it. They are hired. Because from that clarity of principle, foundation, I can build a superstructure up to 9 floors, 10 floors, I can take it. But if that foundation is weak, that fellow doesn't know the logic of accounting, then God on earth cannot make him a chartered accountant. See, if you're getting into advanced topics like amalgamation, reconstruction, blah, 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 bottom line, we'll be seeing debenture redemption and all. Basically, you should be clear with the 3 rules of double entry. Okay, if you are not clear there, in other words, if you are not clear with foundational principles, believe me, studying advanced subjects and spouting bullshit, you might survive for a short while, but in the long run, that person will get caught. For their ignorance will be exposed. So this is not only true for engineers, it's true for many BCom students also. I'm sorry to say, BCom students don't know anything. I'm not joking. After 3 years of BCom, that fellow that lady does not know she doesn't know 3 rules of double entry. One fellow in the interview, he's telling 3 rules of double entry, sir. Yes, sir, 3 rules of double entry. You mean to say, sir, the golden rules of double entry. Hey, golden rules, tell me what are they? Sir, I don't know, sir. Huh? So, sorry to make this comment early in the morning, but that is the problem. Okay, build everything from first principles. Before you pass an entry, find out what are the account, what type of account it is. Then the logic will come straight away. It's a nominal account, what to do. You got the rule. In fact, natural laws like gravity will change when you go into outer space. Natural law, for example, if at all in the next 20 years, and I'm sure we will, in the next 20 years, we will be in the moon. We will be operating mining operations in the moon, and we will be having settlement in the moon. Just like, people from India, they went to America and settled down. Pioneers from England went to US and settled down. The US was built by pioneers who came from all over the world, from Germany, from Sweden, from Amsterdam, from England, from France. And they built, from wilderness, they built the country called United States of America. Like that, we are going to pioneer into moon and Mars. Even when that happens, let us say that in moon or Mars, there is a business, mining business, and there is an accountant like me there, and there is an owner there in Mars. In Mars also, sir, my 3 rules of double entry will work. It is not because in Mars, some other rule will operate. The same debit the receiver, credit the giver will operate in Mars also. So the rules of double entry are universally acceptable across space, whereas the rules of gravity, it's called so-called natural laws, will change once you leave the orbit of Earth. Okay, the rules will change. Okay, so this is my, I know it's a little bit too much, but I am too much. That is the problem. Anyway, no company shall have the power to purchase. Yeah, winding up. Correct, Rashida. Good. Thank you for telling that. No company shall have the power to purchase its own shares unless the consequent reduction in capital is effected in accordance with this act. Why they say with this act? Because under this act, reduction in capital is possible in two sections, 66 or 68. Now, no public company shall give, this is one thing, another thing. Instead of giving back the money to him, what we do, we give financial assistance to somebody for buying our shares. That is also not allowed. No public company, please note, private company can do this. No public company shall give financial assistance for the purpose of or in connection with purchase or subscription of or for shares in the company or its holding company. So, for example, Dubakur Limited shares. Mr. Dubakur, the MD, wants to buy the share of Dubakur Limited. So, Dubakur Limited cannot give loan to Dubakur for buying the share. No. Financial assistance cannot be provided. If Dubakur wants to buy shares in Dubakur Limited, let him get his own money and buy. No loan can be given by the company. Also, they say whether directly or indirectly, meaning instead of giving a loan directly to the MD, you give to some relative or some other company, which is in which he is a firm in which he is a partner, whatever. Everywhere. You cannot give directly or indirectly. Whether by means of loan, guarantee, the provision of security or otherwise. So complete ban. No money, no financial assistance for purchasing the shares or subscribing the shares of the company. Obviously, there are exceptions. Every rule brings an exception. Okay. It is these exceptions that prove the rule. So first exception, lending of money by a banking company in the ordinary course of its business. Got it? See, I'll give an example. Maybe you will be able to understand it. Lending of money by a banking company. Now, I have a portfolio and I feel that the market is doing well now. For the next 1 or 2 years, it's going to be very, very buoyant market. So I'm having some bullish approach. So what I do, I go to the bank and say, hey, kindly fund me. Which bank? For example, I will say some new bank, ABL Bank, whatever. So that bank is very aggressively lending money. They see my portfolio. They were happy. So against the collateral security of my portfolio, they lend me 1 crore or 2 crores. Okay. Now, that 1 crore or 2 crore, I invest in the market now. Right, sir? Now, this ABL Limited itself is coming out with a further public offer. FPO. Let us say that ABL Bank is coming out with the FPO. Now, I am using this loan car money to purchase those shares allowed. Now you understand the exception? Though, in a way, the banking company has funded me for purchasing its own shares, lending of money by a banking company in the ordinary course of business exception. You got it? So that at that time, nobody can say, hey, you are taking money from the bank. With that money, you purchase the shares of the bank. Allowed, sir. No problem. So lending of money by a banking company in the ordinary course of its business. I hope you understood this example I gave you. Funding of purchase or acquisition of shares to be held by employees or trustees for the benefit of employees in accordance with the scheme approved by a special resolution. So, one more exception is, you got employees. You got employees or trustees for the benefit of employees, right? So, the idea is a certain portion of the shares we want to give. It could be ESOP also. It could be ESOP. It may be a ESOP, it may not be a ESOP. It could be an ESOPs. We don't say ESOP, we say ESOPs. Because employee stock option scheme. Then you have ESPS, employee stock purchase scheme. So long as it's done through a scheme. See, the ESOPs is the offer made to the employees. Now, in addition to that, you might formulate another scheme of lending. So the employees come back to you and say, hello, brother, one share worth 3,500 rupees. I'm an ordinary fellow. You're not, how I will buy that share? So you'll say, don't worry. Company will fund you. So each one of you, your eligibility, we will tell you. So those who are eligible for 500 shares, we will give 75% of the amount to be invested. Balance 25 you bring. Like that, you create a scheme. Based on the scheme, those who are opting, they will get. Maybe interest free also because they are employees. Then you might have every month you can say after we allot the share, we'll give you a holiday period for 3 months or 6 months. Then after that, every month salary we will cut. Because we have your, and in case at the time of, if you want to leave the company and go, pay the loan and go. That's all. Nothing wrong. So it's a scheme. If under such a scheme, okay, if you're going, that the conditions are laid out in Rule 16. Logically, what it can be like this only now. Employees are asking money. I'll give. Maybe I won't charge interest, or minimum interest should be charged at the bank rate. Agreed. And repayment. In case you leave the employment, what to do? All these questions are to be answered. That's all. If within the formal accordance of a scheme approved by special resolution, you are giving this loan. Please understand this scheme is different from ESOP scheme. Where ESOP scheme is the scheme by which the employees are getting shares. This scheme is formulated for giving them the loan, and it is approved by special resolution by the members. Then no problem. So funding of purchase or acquisition of shares by persons in the employment of the company. This is B is under a scheme. C is just a loan to an identified employee, single employee. Okay. But other than directors or key managerial personnel, immediately you will come back to me and say, sir, you said Mr. Dubakur cannot borrow for buying Dubakur Limited shares. But you are saying employees can get. Yes, employee can get, but Dubakur cannot get because he is a KMP. He is the CEO. He is the MD. Now he can't get. KMPs are not entitled to borrow. Other employees, other than KMPs or directors, including non-whole-time directors, can take loans from the company for purchasing or acquisition of shares up to 6 months' salary. But MD, no. Okay. So this is the thing. Yeah, in case of private limited company, it appears that the law doesn't want to interfere with private companies. So after all, private companies, they are bringing their own money. What is the big deal? So they say, go to hell. This is one exception to the private company. Otherwise, many of the exemptions to private companies have been removed now. This is one exemption. They say no prohibition on purchase by no prohibition on financial assistance. But purchase, no. Even a private company cannot purchase its own shares unless the consequent reduction. See, whenever you say a company cannot purchase its own shares, don't stop, continue, unless the consequent reduction is affected in accordance with the Act, or unless the consequent reduction in capital is confirmed by the tribunal in accordance with Section 66, or a buyback is made in accordance with Section 68. If you want, it can be elaborate. So we have seen the exception also. See, they are saying prohibition on purchase by a company of its own shares. So suddenly some intelligent person will say, hey, then redemption of preference share also prohibited, sir? No. Nothing is section up shall affect the right of a company to redeem any preference shares issued by it under this Act or under any previous company law. So redemption of preference shares is one more exception to 67. So basically we can say 66, 68. No, if you want to purchase, there is a prohibition on purchase. If you want to purchase, then go through the reduction process or go for a buyback. Okay. Only exception is redemption of preference shares, which can be redeemed as per the terms of the issue. Now, as usual, 67, if you fail to comply, fine 1 lakh. And for officer, fine 1 lakh and 25 lakhs. And imprisonment up to 3 years, not removed. This imprisonment is there. So before Jasprit is asking, I will tell you. See, next, when I'm sending these slides now, I will remove that, my red, and remove that imprisonment itself from the slide so that there won't be any confusion. See, I amended the slide near when the amendment was made about 2 sessions ago. At that time, just now the amendment had come. So I wanted, because some students, what they will do now, they will be referring to old material, wherein that imprisonment will be there. Then they will say to you in the, sir, imprisonment is there, sir, like that. That is why I want to clearly say this imprisonment has been removed by so-and-so amendment act. That is why it's there. Okay. I think Manav got a little angry with me that day. Finally, when he gave a comment, he was slightly upset. He was saying, our intention is not to hurt you and all. Absolutely agree. So, if Manav is attending, let him just give a acknowledgement that he is there. Because I feel bad that I was a little little harsh, maybe. And therefore, he put a nice statement there. Okay, so some of our queries are not meant to argue, but rather to clarify. Absolutely correct. No, you can raise a controversial query, nothing wrong, except that, when you are stating something which is either, I have explained my best and you still feel it is something else, we will beg to differ and do some research and get back is how we can do. Or if you are expressing an opinion and I don't agree with it, what to do, you tell me. So on opinion, we should not fight. On a fact, we need not fight. On an opinion, we should not fight. Because it is your opinion, this is my opinion. I value your opinion, you value my opinion. And leave it. On a fact, we need not fight. Because facts are verifiable. Verify the fact. And if you are right factually, then I am wrong. That's all. Two people cannot be right on a fact. Only one is right, the other is wrong. Whoever is wrong on a fact, what they should do? They should learn, grow, move on with their life. That's all. Instead of trying to deny facts. That is when I get a little upset with students who will deny a fact and keep arguing. Because they have told something which is wrong, they will argue to support their argument, they'll give bullshit after bullshit. Whereas factually they are wrong. So once you are factually wrong, accept, learn, grow, move on. But if opinions are there, express your opinion in clear and unambiguous terms. The other person is willing to accept it, fantastic. Otherwise, mutually value each other's opinion. Move on with your, learn, grow, move on with your life. That's all. Madam, this non-bailable, bailable will come in your final syllabus. It is not in your inter syllabus. Are you very serious about this non-bailable offense? If you want, I can tell, but it will have add no value to your intermediate knowledge. You are using the word non-bailable. Have you understood what it is a non-bailable offense? Okay. For your information, since you have asked this question, don't bother about non-bailable. The real question you have to ask is it cognizable or non-cognizable? That is the question you have to ask. So I have to explain to you cognizable and non-cognizable. Only then you will... Okay, Aisha, all offenses are all penalties, all imprisonment offenses are bailable. Please understand. There's nothing called non-bailable. But when it's cognizable, what happens now? The person cannot get bail automatically. So he cannot get bail automatically. So when he is produced before the magistrate, the magistrate will not allow him to go on his own bond. That is, Mr. A is arrested and is committed an offense under the Companies Act, then he can be given bail automatically. So to use, if you to use the crude way you have put it, I will say, yeah, it is bailable offense. It is not non-bailable. It is bailable. Okay, bailable offense. But why it is bailable? Because offenses under the Companies Act are non-cognizable. Whereas if they are cognizable offenses, then he will be produced before the magistrate and he will be put in remand. And a date will be fixed for a bail hearing. That bail hearing, the public defense, the defender is there now, the public prosecutor. He will be briefed by the Ministry of Corporate Affairs and he may refuse bail also. He will argue that bail should not be granted. Only after the public prosecutor has been given an opportunity to express, then only a bail will be given. So, and bail may be fixed at a higher amount, a collateral security may be demanded and all. So, because he is a flight risk, he will run away, like that some people feel. So, are you able to understand? So, cognizable offenses are more serious offenses. By definition, I wouldn't say they are non-bailable. If all offenses are bailable, but the degree at which it is bailable is different. Non-cognizable, you can just appear in the first hearing magistrate. You can say, I am an MD of so-and-so company. The offense is a non-cognizable offense. Kindly grant me bail on my own bond. Okay, take bail, run. Okay. Whereas if it's a cognizable offense, then, so all offenses under the Companies Act are non-cognizable. Have you understood, Aisha? You asked a question. Have you understood the answer? Okay. No problem. This is not part of your inter-syllabus. This is part of your final syllabus. Okay. So, I don't know, you got that word non-bailable. Okay. I don't know if you're a lawyer or anything. Okay. Now, we come to buyback of securities. Very important, because as a chartered accountant, you must be aware of this, not only from the point of view of law, but also from the point of view of auditing, accounting, everywhere. Section 68 is a very, very important section. See, these are sections that you can remember the number now. You need not remember some unknown section in the corner of the act. But this is an important section, a monumental section. So you can remember this sequence now. 66, 67, 68. These sections can be remembered. Let us say that out of 400 odd sections, out of which 145 are there, 148 up to 148 in your intermediate syllabus, I'm sure you can remember 60. That's all. Your goal should not be, I will remember all the sections like that. No. Remember important sections, which can be quoted. That's all. Now zero down on those important sections. Study them well. They are only going to come in the exam. Why go for some remote section, never tested in the exam, study that hard, and then go to the exam, find nobody is asking any question on that. Whereas section 68, they are asking a question, I didn't study it. Srikanth told, read important portions. I said, you are a fool. And I studied what I thought was important, some remote section. Complicatedly, I confused myself, went to the exam hall. Simple question is asked on section 68, which I never studied or didn't concentrate. So don't let that happen to you. Many students have seen that. They'll be asking all vague questions from some corner of the Board of Studies material. When you know the main portion, they won't know. The main subject, they won't know. When I ask them a couple of questions, they won't know. No, sir. Don't waste my time on all that, sir. You answer my questions. Whether director can go to toilet in the morning or evening. See, such questions are all procedural aspects. Why bother about all that? These are chunk points. These are exam tested questions. They will come in the exam. If so, kindly concentrate on those important. See, your first revision, you read everything once. Second revision, concentrate on frequently tested topics. This is the strategy we use. Yeah, so frequently tested topics means go through either practice manual or scanner or cracker by what's that fellow, Taxman. Something you get it, do an analysis, or ideally do your own analysis. Take the last 20 years, 20 sessions of, means 10 years. So 23 means 13. So 2013 to 23, whatever is now in the syllabus. Of course, there will be some questions which are now out of syllabus. Don't waste your time on that. Take only those questions that have been asked. Prepare a chart which have been asked more. You know what? You can always use a scanner. You pay 125 rupees. Sachdeva will give you a scanner. Okay. On a cheap paper, he will print it and he'll give it to you. Nothing wrong in that. Buy that scanner if you want. But if you do it on your own, you will start understanding. Your eyes will open and your realization will come. Oh, this is important. That is important. Oh, I didn't study that. Then you will start studying those topics which are important. And then finally you will come to those topics which are there, but not very important. Maybe one, but you'll do. That technique will be better. Many students, they have this thing from page number 1 of Board of Studies to page number last. If I study the complete Board of Studies material, I will get 100 on 100 in law. Theoretically, what you're saying is correct, ma. Theoretically, you are right. I will not question your theory, but unfortunately, practically, you will be in deep shit. So, whereas the intelligent student, what they will do, they will see which are all important areas. Attack that first. Even they may leave first chapter itself. Preliminary, they will leave. Definitions, they will leave. Straight away, they'll come to share capital and debentures. Then management and administration. They'll see which have been tested frequently. In that order, you have to come. You understand? Your timetable should be prepared in that order. Okay. Kindly, if you think I'm wasting your time, I'm sorry, but this is how you can get high marks in the exam. Simple secret I'm telling you. Rather than, sir, I studied from first page. Every day I studied. You get bored, you forget. Whereas if you study those important things deeply, you'll not forget. Whereas there may be some remote concept. Yeah. You just read it and keep it in your mind. This is true for all subjects, not only for law. Every subject, costing maybe. You see, check out costing. Every time they will ask you standard costing. The tough question will come. So, intelligent student will first study standard costing. I know it's tough, it's boring, it's irritating, but that is a topic you should cover. Marginal costing, surely one question will come. So, and it will be very difficult to master. So, you will work out 100 problems in marginal costing. So, every day 5 problems. Then like that, labor costing, material costing, once in a while one question, that too, it will be a standard question. With little complication they'll give because it is a CA exam. That you can come later. I mean, this is my view, huh? Not necessarily the view of the Institute of Chartered Accountants of India or the Board of Studies. This is a view expressed by the faculty, who incidentally was also a student once upon a time. Right? From that perspective, I'm humbly suggesting that you can adopt this method. No, sir, don't waste my time, sir. My method is simple, sir. I will take the Board of Studies material. I will read material 1, Kadam ho gaya, material 2, till I come to the last material. I am now prepared. Maybe a good idea. I leave it to you. Okay. So coming to buyback of securities. Section 68 is an enabling section permitting a company to purchase its own shares subject to certain conditions. Friends, normally if I want to purchase my own shares, and 67 says go for 66. That is reduction in capital. But you want to avoid the complicated process of going to the tribunal, getting confirmation and all, especially going to the rascals who are called creditors. After all, after lending money, what they should do? If they have lent money to me now, after that, what they should do? Keep quiet. Don't waste my time. Allow me to run. Instead, these creditors are coming and telling, repay the amount, pay the installment, EMI. No, this is the dialogue of Nirav Modi and all, Vijay Mallya and all. This is the dialogue given by Nirav Modi, Vijay Mallya and all. What is your job as a bank? Lend me money. Repayment and all. Why you are wasting my time? Go. This is the approach of most big borrowers from public sector banks. And the government is also supporting these rascals. They borrowed, they did not repay, and they ran away. This is what happened. So, buyback. So, these people don't want to go to the creditors and all. So, you want to avoid all that hassle. Then, if you can fit yourself into 68, yes, you can buy back up to 10% or less of paid up capital plus free reserves may be made with approval by a board resolution passed at a board meeting. But if you want to buy more, up to 25% of paid up capital and free reserves may be made by passing a special resolution in general meeting authorizing buyback. So you can buy back 10% of your paid up capital and free reserve with approval of board resolution, or 25% or less of paid up capital and free reserves by passing special resolution. No tribunal, no central government, nothing. You just simply have to comply with the rules. That's all. Okay. This is called buyback. So if your buyback value is 10% or less of the paid up capital and free reserves, then board resolution is enough. If your buyback value, see, I say buyback value because value of a buyback could be nominal plus premium. See, boss, today, if you want to see, TCS is going for a buyback. So one share value of TCS, you should know. The nominal value is only 10 rupee. It's not even 10 rupees. I think it's also 1 rupee. I don't know is the answer, please. Huh? I don't know. If you want, you can check out. But the point is, even assuming it is 10 rupees, that is only the nominal value. If you want to buy back TCS shares, you have to pay the entire amount. So Wipro came out with the buyback recently. I think I told you. So they offered 385 rupees or something. 385. No, 445 rupees. Wipro buyback offer 445 rupees. Recently, Wipro came out with the buyback. 445 rupees. When the shares are quoting 385, now they've gone down. Wipro gave a negative result. Superb shot. Ultimate shot. These guys are better than Heidelberg, I'm telling you. Because what they did, they announced a buyback at 445. Then they announced a Q1 result, which is not good. So the price of the share is going down. Okay. So I'm sure somebody is buying it from their own pocket. So the company has bought back the share and closed the liability. Now from the market, the promoters may be buying of their own sources. I'm not saying Wipro is funding them, but they are buying at prices that they know they have fallen now. They are buying back. Okay. So I'm sure they are taking it out. Right. But simple logic. Why would a company want to do a buyback at all? Friends, what I'm now going to tell you will be very, very difficult to understand. And this is your real test of financial awareness. whether you are fit to be a CFO of a company will determine on the answer you will give. Why would a company go for buyback? Your answers are welcome. I'm teaching you the legal part of buyback. No problem, I'll teach you. But why would a company go for buyback? Under what circumstances would you, as a CFO, recommend buyback to your company? Are you able to understand the question? And this has nothing to do with company law. So you may also say, go to hell and not answer me. But if you can give the right answer for this question, then you are now ready for finance activities. You are ready to become a CFO of a company. But if you don't know the answer to this question, then you are a book learner. You will be able to pass the exam. But so this is a different question. When would you as a CFO recommend a company to go for a buyback? What will be the logical time when you would say, hey, I think it's a good time, sir. Let's go for a buyback. Here's an opportunity. Let's buy back now. When would you do it? Good. So if a company wants to buy back up to 10% board resolution, up to 25% paid up capital in free reserves, special resolution in general meeting. If you're able to willing to do this, you can buy back 25%. So it's a good now. You can buy back. Jaspreet is giving a very correct answer. Let us see if others, but she is giving it in a vague way. But she is there. She is there. She's understood the point. I'm very happy to say Jaspreet understood the point. Aisha is again giving a very generic answer. To increase their proportion of ownership. These are all standard answers. I think Jaspreet only got the point. See, let's see if anybody else is able to give the correct answer. Darshan, you are giving textbook type of answer. You are not giving the real insight. 100% because there are too many shares in the market. No. Diksha is saying when company is willing to reduce its liability. When would that happen? You are begging the question. You are given an answer that is begging the question. My question is when? When would you be willing to reduce the liability? When it will be better? As Jaspreet says now, it is more profitable than paying it back. When would that happen? Okay. Chalo, you keep thinking. When company don't want more new shareholders. Hello, madam, you are buying back from the existing shareholders. Where is the new shareholder coming? If you don't want more new shareholders, don't go for further public offer. FPO. Don't give your shares to the public more. Over there, no, it's enough. You are reducing it. From existing fellows, they are buying back. I really don't see the connect. I really don't see your answer connecting with my question. You don't want more new shareholder? Good. Boss, reduce its liability, but when would you do it? Now Darshan has started realizing. Now Darshan has woken up. Okay. Now Darshan has woken up. Now he is nearing the solution. When the shares are quoting, meaning when the shares are trading or quoting in the stock market at a discount. What do you mean by discount? What discount? See, most of you are thinking that buyback is done for gaining control. Not really. Not really. Yeah, in some cases it is done. At the time of, what shall we say, delisting of securities, there would be a buyback of the public shareholding. And the promoter stake will become 100%. But that is rare. And that again may be financially unviable. See, think about it. The company has an intrinsic value. You as a chartered accountant should learn how to do that. Every company has an intrinsic, as a business, it has an intrinsic value. That intrinsic value is what it is worth. Now, if it is quoting in the market at more than the intrinsic value, fantastic, but not a good idea to buy. Why should I buy? When the intrinsic value itself is only 500 per share, why the hell I will pay 900 or 1000 for this fellow? Merely because some fools in the market are willing to buy it at 1000, I will not touch it at 1000. But on the other hand, suppose I have computed the intrinsic value. I have valued this company and I find that its intrinsic value is 300. I'm sorry, its intrinsic value is 500. but it's quoting in the market at 300 or 400. Boss, fantastic opportunity to buy, ma. It is a logical opportunity for me to buy for my portfolio. If you are a CFO, for you also, it's a logical opportunity. If the company is also having surplus money, straight away, you buy back 25%, thereby reduce the liability. But you will do it only when the intrinsic value is higher than the market value. The market is undervaluing your company. Only then you have to do it. Otherwise, if you do it, it will be, for example, if you go for a buyback, when the intrinsic value itself is only 500, only a foolish CFO will buy back when it is 900, yeah, paying 400 rupees more premium for what? Let the donkeys keep the share. Later on, when the market stupidly undervalues my company, due to some cyclical problem, at that time, I see an opportunity. Then I will buy back, because then I will gain. I think Jasprit got the point and Darshan got the point. Yeah, not only when it is very low in the market, please understand, it should not only be low, it should be lower than my intrinsic value. Okay, this is, I know it's a little technical, but that is the reality. Suppose I'm having surplus funds, why I will buy back from those donkeys? Why should I? Because I have money, why I pay those fellows? No way. Let them sell in the market and go. So my intrinsic valuation I have done is 500. Whereas market is stupidly willing to pay 900 or 1,000. Now is opportunity to possibly go for an issue, a further public offer, and get a premium from these buggers, from these donkeys who are willing. But suppose it is lower than the, exactly, now you are coming to the real point. You perform a discounted cash flow valuation. Do it properly. Risk assessment. Future, you know better than everybody else now. You have all the information with you. Do a realistic valuation of your company. You will get a number. If the market price of the share is below that number, you can go for buyback straight away. Which is why Wipro is going for a buyback. Which is one of the reasons why many times TCS, came for a buyback. I refused to sell the share. I said no, because you know that you are worth more, and I also know that you are worth more. Why I will sell my share? I will not sell my share to you. Even if you make an offer for buyback, intelligent shareholders may not accept the buyback offer. For example, Reliance buyback bombed many times. Whenever Reliance wanted to buy back the share, shareholders were not willing to sell. Because obviously Mukesh would have gone or Dhirubhai would have gone when the market was underestimating Reliance. Mukesh has got better information. Dhirubhai would have had better information than you and I. So they knew this is too much. I will buy back. But shareholders were smart. They would have said, no, Dhirubhai ji, I will keep the share. I won't sell it to you. So they are smart people. Anyway, see this, I'm so happy that you are able to appreciate this, because you use the word financial literacy. That is one level. You are going to become chartered accountant. You have to attain financial expertise. Literacy is what Amadmi, Munalal and all. I am talking about you and I. We should be financial experts, where our knowledge level should be expert knowledge. Okay, so coming back to the mundane topic of buyback. So if a company wants to buy back, it can do so up to 25% of paid up capital and free reserves. Now, in respect of the buyback of equity shares in any financial year, the reference to the 25% shall be construed with respect to its total paid up equity capital in that financial year. This means a company cannot buy back more than 25% of its paid up equity capital. Please understand, paid up equity capital hai, okay, or market price hai. Paid up equity capital is only 10 rupees. So let us say a company is having 10 lakh equity shares of 10 rupees each. Paid up equity capital is 1 crore. So I can buy back how many shares? 10 lakh shares. I can buy back 2,50,000 shares. 2,50,000 shares. Am I correct? There are 10 lakh shares. I can buy back 25% of the paid up equity capital. So I can buy back 2,50,000 shares. So this is the limit. I cannot buy back more than 2,50,000. Now, 2,50,000 shares to buy back, I cannot buy it back at 10 rupees. Let us say that the market price of the share is 60 rupees. Then 2,50,000 shares into 60. Are you able to understand? Into 60. As usual. I have calculator now. I always use calculator. Why waste my brain for? I rather use my brain for Milton and Shakespeare. Why I will waste it for mathematical calculation? So 2,50,000 shares into 60 rupees means 1 crore 50 lakhs I need. How much I need? 1 crore 50 lakhs. Kyun? Because I need to pay these donkeys 60 rupees per share if I want to buy back. I may fix it at a certain price. Let us say that the market quoting at 45, 50. I have to sweeten the deal now. So I'll put it at 60. So to pay these fellows 60, I need to generate 1 crore 50. Now that 1 crore 50 lakhs should not exceed 25% of paid up capital and free reserves. Are you able to understand? The amount needed or utilized for the buyback should not exceed 25% of paid up capital and free reserves. You just write down the numbers I've given you. 10 lakh equity shares of rupees 10 each. Paid up capital is 1 crore. Let us say that the free reserves is another 1 crore, or let us say 1 crore. So free reserves 1 crore, paid up capital 1 crore. So total 2 crore. Am I correct? 2 crore into 25%. How much I am getting? 50 lakhs. Whereas if I want to buy back 25% of my paid up capital, that is 10 lakh shares, I can buy back 2 lakh 50. I need 1 crore 50. Whereas I am having only 50 lakhs. Now how many shares I can buy back? Now what I should do? 50 lakhs divided by 60 rupees. I get something like 83,333 shares. I cannot buy back 2,50,000 shares. I can buy back only 83,333 because these two conditions are to be studied in together. I can buy back up to 25% of paid up capital, equity capital in each financial year. But that is the number of shares I can buy back, maximum. The quantum, the amount which I can utilize is restricted to 25% of paid up capital and free reserves. Right? So this is a mathematics that you might want to think. I'm sure this would be relevant to you in accountancy. I'm sure what I'm now teaching you is not something new to you because you would have studied this in accounting also. Okay, for buyback entries and all that stuff. Good. Now, one peculiar thing is they are referring to 25%, but they are not referring to 10%. They are not referring to 10%. So I don't know whether this condition applies to 10%. Whether this restriction is applicable to 10%, I don't know. Seriously, don't know. So even then, I suppose in any year you can buy back, if you want to pass a board resolution, 10%. So out of 10 lakh shares, you can buy back 1 lakh share. For that, you can use only 10% of paid up capital and free reserves. That is 2 crore into 10%, 20 lakhs. So you can't buy back 1 lakh shares. You can buy whatever you get only, you can buy back. Okay. So please understand. So even though they use the word 25% in this section 68, I think logically it applies to 10% also. Anna, Shubham Anna, you are vague on the subject, Anna. Anna, we are talking about buyback of securities by the company, Anna, not the major shareholders. Shareholders have nothing to do with this. Please, this is buyback of securities by the company, purchased by the company of its own shares. Okay. Company buys back. So once the buyback is done, what happens? Debit share capital. Share capital will be closed. The liability will be closed after that. The share capital will be reduced to this extent. So who is buying? Not major shareholders. No, company. Shubham, have you understood? But I find from 2 of your responses, Shubhamji, that you are weak on fundamentals. So kindly do a little more deep study. Try to understand that. I hope you have been attending my lectures. So do a little more deep study and try to concentrate. Please do. Okay. So sorry to make this comment, but I know you are feeling bad, but I hope now you understood. Kindly confirm that you have understood that I have clarified. We are talking about purchase by a company of its own shares. Major shareholders have nothing to do. There is nothing called major shareholder and all, so don't get confused. Okay. So kindly confirm, Shubham, that you have understood, because if you have not understood, you will be wasting your time. I give an example also. See, the paid up equity capital face value rupees 10 is 100 crore. Face value. Correct. See, in this example, I will show you. See this example, I will show you. Just breathe. Then you will know. Paid up equity capital, face value rupees 10, 100. Paid up preference capital, 200. See, preference capital is included in paid up capital. That is another point you have to understand. When they say paid up capital and free reserves, paid up capital, see here note, 25% of paid up capital and free reserve. Whereas here it is 25% of paid up equity capital. Got the difference? So, paid up equity capital 100 crore, 10 rupees each. Paid up preference capital 200. Free reserves 200. Meaning reserves that are available for distribution of dividend. One more thing. In this list, for the buyback purpose, we can include security premium also. Security premium also. See, buyback can be done out of free reserves, securities premium, or the proceeds. So, securities premium also can be used. So, in case security premium account is there, that can also be included here. Right? So, for your information. Now, 100, 200, 300, 200, 500. Now, 25% of paid up equity capital. Please understand, you are asking 25% should be checked on both sides. Be careful. First time you have to check 25% of paid up equity capital. 25% of 100 crore. 25 crore. Market price is 50. That's where you have to be very careful. Market price is 50. So 25% of PC plus FR, that is 25% of 500 crores is 125 crores. Number of shares we can buy back, 25 crores. Am I correct? No. 2 crore 50 lakhs. 2 crore 50 lakh shares. Amount required, 2 crore 50 lakh shares into 50 rupees. I get 12 crore 50, no, 125 crores I need, which is the amount you can buy back. Exact amount. You are eligible to buy back up to 125 crores. 2 crore 50 lakh shares. Meaning 25 crore is the amount divided by 10. I get 2 crore 50 lakhs. Number of shares. Number of shares which you can buy back is 25 crore divided by 10. 2 crore 50 lakhs into market price is 50. Or maybe you are fixing it as 50. See, sometimes, you cannot buy it back at market price. Though, there are two ways. One is to go for an offer and at a price. Or the other is, you will announce, we are going to buy back 2 crore 50 lakh worth of shares. Open offer. Anybody willing to sell during the market? At the market price, we'll buy. You can. No, normally, they don't do that. They make a buyback offer, very clearly saying, we are willing to buy back your share at such a price. The buyback offer will open on such and such a day, close on such and such a day. Our brokers are ready to buy it. So through your DP, through your broker, you tender your share. There will be a tender document by which we will tender. It will be submitted. Then the company will accept the tender. Whatever they are accepting to buy back, sometimes, they may buy back more than what they are told. Also, so what you normally should do is when you are tendering for buyback, don't restrict yourself to what you are eligible to be bought back. So they will say, we are willing to buy back so many shares. For every 100 shares, we'll buy back 10. Something like that, they will say. You can offer your entire shareholding or you can offer 50% of your holding. Because chances are, if other people are not offering and there is some over offer from some people, that over offering can be taken by the company. So long as in total, they do not exceed 125 crore. And in total, they do not buy back 2 crore 50 lakh shares. Okay. So this numerical example is given to help you understand the law. This could be useful to you in accounting paper also. So if you have any doubts on this. So to answer Jasprit now, you should check on both sides. What I mean by both sides, I don't know. You should check first paid up equity capital, calculate the number of shares which you can buy back. Then you have to calculate 25% of paid up capital and free reserves. there will be the amount you can use. Then you should ensure that the number of shares you are buying back, okay, should that amount of price you are paying should not exceed 25% of paid up capital and free reserves. One more point, paid up capital includes preference capital also. One more thing, security premium account can also be included. By obviously, boss, Darshan, why I will buy back preference share? Yeah, you got redemption of preference share now. You're at the time of issue itself, you're telling I will redeem after 5 years now. Why buy back? You go for redemption. Okay. So members have always equity. Buyback means equity only. Okay, not share preferences. Okay. Sir, if members have the power to make decisions about buyback, then wouldn't that be deceiving to themselves? Boss, special resolution is passed by those fools who send in that postal ballot form. See, buyback should be done by postal ballot. Yeah, it's up to us. It's not as if somebody is forcing you to sell your share. Yeah. I am making an offer, take it or leave it. If you don't want it, leave it. Don't sell. That is why. Okay. That be deceiving to themselves only as in sense to whom shares need to be debited. Subham, the question is not at all clear, but I think you are meaning that why would the members sell? Correct. There have been many buyback offers that have bombed, that shareholders have rejected, means they don't offer. Yeah, boss, you make a public announcement, you send a mail to all of them saying we are willing to buy back your share. If you want, you offer it. Nobody offers it. What happens? You quite pay the merchant banker some fees, and whatever has come, take it and be happy with what you got and go. Okay. So that depends on the smartness of the individual members. Yeah. If the members, they have control. That is why he is saying you have to pass a special resolution. Of course, up to 10%, they are saying board itself can take the decision. Did you notice that? Boss, I'll tell you, he's talking about all the shareholder thing and all. I am running a company here, ma. As far as the company is concerned, the shareholder is also an outsider only. He is a liability. Am I correct? Intelligent CFO will think, why keep this liability when the market is underquoting me? Buy back. If some donkeys are willing to sell, buy back from them. But if smart people are there like Darshan, like you, like me, like Jasprit, we don't sell. Nothing can happen. So the idea is that you can't see. I don't understand why you are asking this question also. Because buyback 68 is there. If you are not happy with 68, then you inform Nirmala ji, she will remove it for you if you want. Yeah, if you tell Nirmala ji, she will remove the entire Companies Act from your syllabus. There, from tomorrow onwards, Companies Act is entirely abolished. Do whatever you want, run naked. I mean, the rules and regulations are made here. So, see, when there is an opportunity in the market, if the 68 ka control is not there, an unscrupulous promoter will buy back directly without control, full amount. That is why they have restricted you to 25% now. See, these opportunities come once in a while. And smart, see, there should be a lot of combinations, ma'am. Your company should be doing well. Otherwise, intrinsically valuable company. Market is stupidly underquoting it. 2, 3, you have enough financial strength to buy back. Most times, when the market is underquoting you, the chances are it's a recession. And you are also equally financially unsound. You may not be able to buy back. You can only see the opportunity there, but you can do nothing about it. Because buyback, if you want to do a buyback, you have to do it only out of accumulated profit. You cannot borrow and do a buyback. So you have to go for a free reserve or securities premium account. Or the proceeds of the issue of any shares or other specified securities. But one thing, if you are going to buy back specified securities, then you cannot do so out of the proceeds of an earlier issue of the same kind of shares or same kind of other specified securities. So basically, if you want to buy back shares, then you have to only issue debentures or preference shares, because you cannot buy back equity shares by issuing fresh issue of equity share. You have to go for a fresh issue of preference or debenture, and you have to do it. You can do it. If you don't have money, you can go for a preference issue. Vaishali ji, am I including preference capital in free reserve? No. Free reserve is separate. Third line entry. We are including preference capital in paid up capital. Are you able to understand? Preference capital. Paid up capital means paid up equity and paid up preference. Total is called paid up capital. Free reserves, how I can include? No way. I'm not including. Have I included here in free reserves? Got it, Vaishali? It is why I'm making this point now. Sitting in the exam hall, if they ask you a numerical problem, you will forget it. And you will take only equity capital. So again and again, I'm shouting, paid up capital includes preference capital. Paid up capital includes preference capital. This is relevant for you, which is very important. Free reserve, how it will include? No. Free reserve will not include security premium. If security premium is the balance sheet, that can be considered because that can be one of the sources. So one more line will be there, security premium account model. Have you understood, Vaishali ji? Why I'm asking you to confirm your understanding. In a real class, in a physical class, I can see your face. I will know immediately I've understood or not, whatever. Here, I cannot see your face. Of course, you can see my ugly face, but I cannot see your face. So imagine that I am a blind man. Imagine I'm a blind man conducting a class. That's what is happening for me here. I am blind. Though I have eyes, by the grace of God, these eyes can only see the laptop in front of me. I cannot see your faces and the facial expressions and the body language. So as a teacher in physical class, now I study body language. In the last row, out of 100 students, the 100th student should understand. But his body language will tell me he has not understood. Then I will go to him and make him understand. That was the way I used to teach in physical classes. But in online, how can I teach like that? It is not possible. And I have also accepted that because I am also 57 years old. I can't walk all the way now. My knees are going slowly. So I'm happy with what I'm doing here. But still, if you interactively confirm to me, you have understood, or if you still have a doubt, you ask. I will further clarify. But Subham, first step to you, foundation. Be thorough in principles. First understand. And then you will be able to appreciate. My humble request. And do it very fast. Thank you. Definitely. When I'm coming that side, I will tell you whichever city you are, you tell me, I will send you or go on LinkedIn and connect with me. If I'm touring in Punjab side, I will definitely make about it. At least once in 2 years, I come that side, Chandigarh, either for lecture or for holiday in Shimla, or that side I go, or I will definitely, Himachal Pradesh I go, definitely stop. There are a lot of places in the north that I would like to visit. For example, Saharanpur I want to visit. Nothing there, just to see Mera Bharat Mahan. And I want to visit everywhere and see these places and meet people there. That's about it. Saharanpur is a place like that. I want to go and that part. Just see how it works. Patiala, one of the most famous places. I'm a great fan of one of the famous Sikh rulers. I'm a great fan. Of course, the 10 gurus are there. They are great. We have to respect them, all the gurus. Till the last Guru Gobind Singh, who then gave the Granth Sahib, and he said, worship the Granth Sahib. After that, you had one great king, Ranjit Singh. And I would like to, visit historical place where Ranjit Singh ruled and all. Ranjit Singh was one of the great kings of India. He was the only man who could give, the English could not truly conquer us till Ranjit Singh was there. Mughals were out. The Mughal Empire was out. But the English still, Ranjit Singh was giving them run for his money there. The British were afraid of Ranjit Singh. And the Mughals were afraid of Ranjit Singh. Okay, so really one of the last frontier of independent India was Ranjit Singh. After that, British took over. That was possibly with the Ranjit Singh era, completely Marathas gone, Ranjit Singh gone, Mughal gone. Then the British came and then they ruled us for 200 years. You can search for Sridharan Srikanth. Look for Sridharan. My father, SRWDHARAN. Search for Sridharan Srikanth. You will not find a chartered accountant profile there. So you will not find a CA profile. You will find a HR profile. You will find that I'm more projected there as a corporate trainer than as a practicing CA. Because as a practicing CA, I have got enough opportunity and enough clients coming through my other methods of meeting people. So this is meant for corporate training. So look for Sridhar and Srikanth with your corporate trainer profile. You will suddenly find there are no strangers in our life, only friends we have not met before. You will see that there. Chalo, good. We are making good time. But it's already 8:30. I have to go till 9:30. We'll finish somehow. We'll finish today. So sources of funds for buyback. Yeah, very, very important. Debt to equity ratio should not exceed 2:1. See, in this case, suppose there's a debt also. Post buyback, what will happen? Post buyback, the equity will go down because you will buy back 25%, 2 crore. You will buy back to 2 crore 50 lakhs now into 10. 25 crore ka equity will go, plus that amount you are going to utilize now, 125 crore. It is going to come out of free reserves now. Free reserves now. So free reserve will go down from 200, it will go down to minus 125, 75. Paid up equity capital will go down to 75. So the equity will come down now. The net worth will come down now. Now, after the buyback, this equity we have to take and see the debt. Post buyback, the equity will come down, but the debt may remain the same. Still, the debt equity ratio will change. Now the debt will become more than the equity. That ratio should not exceed 2:1. So if it's a debt heavy company, post buyback, the debt will be huge. The equity will come down. This is to prevent unscrupulous promoters from buying back their own shares, but not settling the debt, keeping the debt. So they are saying minimum 2:1 debt should be there. If it is more than that, then find out what is 2:1. See, there is another mathematics. Find out what is 2:1. To that extent, only equity can go down. And then find out how many shares, etc., and then see. So there are 3 levels of restriction. 25% of paid up equity capital, then the amount utilized, 25% of paid up capital and free reserve, and finally debt to equity ratio not to exceed 2:1. Of course, for certain infrastructure and other companies, they may prescribe a higher ratio. Shares for buyback should be fully paid up. The buyback of shares of listed companies to be as per SEBI guidelines. SEBI has given elaborate guidelines, especially on pricing. For public issue, for listed company ka buyback, the buyback price will be determined based on the quoted price for the last 21 days, 6 months average and all you have to see. And then you have to buy back. Buyback of shares of listed companies. Buyback of shares by unlisted companies as per Rule 17. Once you made one offer for buyback, another offer of buyback cannot be made, not to be made within 1 year of closure of preceding buyback. So when they announce the buyback, they will give closure date. By that closure date, if you don't get, or if you got, good. But once you close the buyback, you cannot make another buyback offer for 1 year, only after 1 year. So which means what? Quietly, the board of directors can buy back 10% of the paid up capital and free reserve every year. 10% of the paid up equity capital can be bought back quietly every year. This is called creeping buyback, where slowly you reduce that liability over a period of, say, 6 years or 7 years, you can buy back, and then the balance also buy back, get delisted, enjoy, run away. Okay, this is a fantastic thing now. Fellow starts, pumps his money, builds the business, gets a valuation, takes money from the public, uses that money, makes more money, then suddenly when the market is not well, he starts, or every year he takes out 10%, 10%, suddenly public shareholding purchased back. Now promoters are there, delist yourself, go back. So effectively you have used OPM, made money, come back. But I have not seen anybody do that. Once they get into the public issue now, they get into the whole thing and they never come back. Okay, as they keep expanding, they need more money, so more equity, more debt, keep on going. Which is why buybacks are rare. Buybacks are rare. It's not as if every day you'll get a buyback. Okay, buybacks are rare. From whom you can buy back? From existing shareholders on proportionate basis. This is called tender route. I told you now, which is normally used. For example, Viproka recent buyback was a tender route where they offered for 45 rupees, sent a mail to all of us, gave us the date of opening. We were all willing to offer. So I directed my broker to offer it. Then he offered it. They took some shares. I don't know how many. My secretary told me some money has been taken. They gave it. From the open market also you can buy back. Means, as I told you, no fixed price. You say the buyback is open, make an offer. So the brokers of the company would be buying in the open market. But SEBI will be monitoring. This will be done on the buyback route. Once that limit is reached, the broker will stop on behalf of the company. And then remember, whatever you are buying back, those securities have to be cancelled. That's it. They have to be removed, destroyed. Means the record will be removed. That way, the equity capital company. See, abroad, your own shares can be shown under investment. Abroad, you can have investment in your own shares being shown in the balance sheet as investment. In India, no. Once you buy back, liability will also be cash bank balance will reduce, share capital will reduce. That's it. And you will transfer, we'll be seeing that. You will transfer the amount of profit which you are using. The amount you are using from free reserves will be transferred, securities premium, etc. will be transferred to CRR, capital redemption reserve. So once all those entries are passed, that's it. Also, lastly, when you are giving an ESOP, now, you might have a buyback option built into the ESOP. You can tell the employees, hey, don't worry, in case there is some problem, we will buy back your shares. So that the employees get some sort of. So under a scheme of employee stock option, there may be a buyback option where they might say, if the price falls below a certain limit, we will buy back from you. It's more to assure the employees. Buyback should be completed within 1 year from the date of passing of special resolution. So maximum you can finish it within 1 year. Shares or securities so bought back shall be extinguished and physically destroyed if they are physical certificates. But if it's a records of a depository, it will be deleted. It should be done within 7 days of the last day of completion of buyback. Okay. The chartered accountant, the auditor should give a certificate also that it has been done. Those shares can again never be certified. Company not to make further issue of securities of the same kind within 6 months. Okay. Meaning, once you make a buyback, you cannot make an issue of the same securities. Means you cannot go for buyback and then within 6 months you cannot come with a further public offer of equity. Okay. Exception is bonus issue. Bonus shares can be given. In fact, they could be given because you will transfer the profit to the CRR now. That CRR can be used for bonus. So nothing wrong. Conversion of preference shares or debentures allowed. Discharge of subsisting obligations on warrants, if any. Suppose you have issued warrants, they want to convert into shares, you have to. Stock option schemes. Sweaty equity may have you can issue. All this is allowed, but you cannot make a further issue of the same securities. So buyback quickly procedural, special resolution to be passed or a board resolution, depending on 25 or 10. Declaration of solvency in form SH9. Declaration of solvency is an affidavit. It's a sworn statement given by 2 directors, one of whom shall be MD, that the company is capable of paying its liabilities in full within a reasonable time of say maximum 3 years. Means at the time of buyback, the company should be capable of paying its liabilities in full. An insolvent company should not quietly buy back and get away from the liability. So the declaration of solvency has to be filed. Similarly, there should be a register of shares and securities bought back. And after completion of buyback, a return should be filed in form SH11 with ROC and SEBI. Declaration of solvency to be verified by an affidavit, meaning sworn statement, solemn statement on a stamp paper. Affidavit should be on 20 rupee stamp paper in Tamil Nadu. I'm sure in Maharashtra also. I don't know about other states. 20 rupee stamp paper in Tamil Nadu. So declaration of solvency to be verified by an affidavit to the effect that the board has made a full inquiry into the affairs of the company, as a result of which they have formed an opinion that it is capable of meeting its liability and will not be rendered insolvent within a period of 1 year. of the date of declaration. So idea is, after making the buyback within 1 year, it should not become insolvent. After 1 year, they may become, but with 1 year, they will not become insolvent. An explanatory statement also should be given along with the notice for special resolution, full and complete disclosure, necessity for buyback, class of securities, the amount to be invested, the time limit. Everything has to be mentioned. As I told you, if you are redeeming, if you are buying back equity out of free reserves, then to the extent of the nominal value of the shares so purchased, the CRR account should be created and the amount should be transferred to the capital redemption reserve. Similar to redemption of preference shares. When you redeem preference shares out of profits, the amount out of profits amount now should be transferred. The nominal value of the preference share should be transferred to CRR. Same here. The nominal value 10 rupees will be transferred to CRR. And you are aware, no? CRR cannot be used for declaring dividend, but it can be used for issuing bonus shares. Now, a company may be prohibited from making buyback in certain circumstances. A company is prohibited from buying back its own shares directly or indirectly through subsidiaries or investment companies. So, company cannot buy back. It cannot buy back through subsidiaries or investment companies, meaning special purpose vehicles into which this company will put money and that company will buy. That's called investment company. You cannot do it if you have not done these things. So there's a prohibition of buyback. In case the company has not repaid deposits or interest, or they have not, there's a default in redemption of debentures or preference shares, default in payment of dividend, default in repayment of any term loan or interest thereon to financial institution. In case there is any default subsisting, you cannot go for buyback. Okay, I have remedied the default. I have paid. Can I go for buyback? You can, but only after the lapse of 3 years. So, see, are you able to see the check and balance? While buying back is a great opportunity for the management of the company, for the promoters or for the company itself, unscrupulous promoters are prevented from doing nonsense. For example, debt to equity should be maintained. There's a limit of 25% and 10%. Debt to equity should be maintained. So many checks and balances are there. You cannot, further issue cannot be same kind of security. Okay? Like that. Declaration of solvency. Finally, they are saying if you are defaulter, you cannot go for buyback. See, in my humble view, this buyback provision, of course, one good thing about buyback section is they have not disturbed the original 77A much. Those sections in the Companies Act where the MCA has not meddled, where they have not gone around doing any nonsense, where, as somebody called it, they have not done any monkey tricks, Korang Cheshte they have not done, where they have kept quiet, those sections are beautiful sections. It's only when they have put their hand in and tried to do some nonsense, that is when the section becomes useless. Like you saw rights issue now. 81 was a beautiful section. Simply that could have brought in here with a little bit of correction. It would have been a beautiful section. But they have to go around playing games with it. In Tamil, we call Korang Cheshte. That is monkey tricks, monkey behavior, where they go around meddling with it. That is when the problem starts. See, the original 56 Act was a beautiful act. It had certain lacuna. Those lacunae could be removed. That's all. And the main act could have been surveyed. Some sections needed to be removed. Some blank section needed. Renumbering needed. Some amount. That's about all that was needed in the law. And some new sections could have been added the way they have done and all. Instead, these fellows, they reinvented the wheel. We will want new law. Why new law? Old law is good. Maybe call it 2000, the Companies Act 2013. But let the old law continue with modifications. My humble view. Anyway. Now, this is thing. In case the company has made good the default also, they cannot go for buyback for 3 years. Similarly, company is prohibited from buying back its own shares directly or indirectly through subsidiaries or investment companies if there is non-compliance with the provisions of 92 and 129 regarding filing of annual report and 123 and 127 regarding declaration of dividend and failure to distribute dividends. See, please note, these two defaults, if you comply with them, you can go for buyback. If you comply, you can go for buyback. Whereas here, even if you make good the default, you can go for buyback only after 3 years. So if in case you have not filed annual report or financial statement, go and file it, then you can go for buyback. If you have declared dividend and you have not distributed it, then distribute it, pay it, then you can come. Okay. Later on, we'll be seeing declaration and payment of dividend, 123 and 120. I will be teaching you. At that time, we will talk about it. See, Jasprit ji, imprisonment is not there. In fact, why I will do one thing. Right in front of your eyes, I will remove it. See, this imprisonment was removed in 2020. Now it is not there. Now it's clear now. I think now Jasprit Kaur cannot have any anger with me. She will be happy. No imprisonment. Only fine 1 lakh to 3 lakhs. Officer 1 lakh to 3 lakhs. Or also to be removed. Or nothing. No. Now I think you are happy. Okay. So there is a penalty of 1 lakh up to 3 lakhs for default. So I even asked this question here. I should have put it there because I didn't want to put it there because there should be a, but now I think you understood. See what happens now when you reduce the number of equity shares, your EPS will go up now. Automatically what happens once your EPS goes up, your P evaluation will go up. Thereby, in a way, a buyback of securities will increase the wealth of the remaining shares. Once the market corrects itself and goes back to its correct position, everybody will become wealthy. In a way, we are getting the money out and giving it to shareholders. This should answer Subham also. See, you reduce the outstanding shares, you take the money from the company and give it to the shareholders. Then later on, the market will correct itself. And everybody is wealthy again. Okay. But many times, buyback is also seen as a business lacking growth opportunity. See, if a guy is coming around doing buyback, what does it mean? He has no other options to invest. Usually, cash-rich companies, which are not having any great expansion plans, they will also go for buyback. But sometimes cutting-edge companies also go for buyback. In fact, for your information, this is a general point. Are all buybacks successful? No. See, before TCS announced India's biggest share buyback of 16,000 crore shares via the tender route in 2018, Reliance Industries carried out before TCS. TCS was bigger. Before that, Reliance was the biggest, 10,440 crore. However, see, Reliance went for a buyback in 2012 to 13 now. They wanted to buy back 10,440 crore, whereas they could buy back only 3,900 crore through open market purchase. See, obviously, they saw an opportunity there because this was after Dhirubhai. Mukesh saw, or maybe Mukesh and Anil together saw. This was even after Anil went away. Anil also gone. Bye. Good. Get out. Attack. Go. And no. So they wanted to. So they saw a huge opportunity. Reliance was underquoting. In fact, people were telling, don't buy Reliance, don't buy. That is when I bought Reliance. This is exactly the time I bought further shares in Reliance. Okay. Huge opportunity. Mapala, it was going at 900 rupees, 800 rupees. Yeah. Hey, if nothing happens, Reliance goes into winding up, you will get 1,000 to 500 rupees. Nothing happens. No brand, nothing. You sell the assets, pay the liabilities. You will be given 1,500 rupees per share. Forget it. At 900, it is a throwaway price. But people were advising me, Shrikant, don't buy Reliance, bad company. They were telling me, see, ethics and all. What ethics? See, market is quoting here. I'm not, see, ethics is different. And one more thing I'll tell you. Reliance Industries may have certain background information and all, but As a company, they have never cheated anybody. And they have only rewarded the shareholders and they have done well. Yeah, they use governmental mechanism and corrupt politicians to gain advantages. No doubt about it. I'm not denying it. But to the shareholders, they did not do any fraud. Unlike, people like this, I can give you 100 names, including Ramalinga Raju, who cheat the shareholders. Okay. What? So what? Whereas Ambani never cheated the shareholders. Dhirubhai never cheated shareholders. Mukesh never cheated shareholders. Okay. Unlike Ramalinga Raju, all sorts of fools. I think the Ratan Tata also never cheated shareholders. Okay. Rewarded shareholders, but never cheated. So, TCS buyback was somewhat successful in 2018. Even I gave my shares. First time I gave my share, then I realized my mistake. I said, Mr. Ratan Tata, no, I will not give my share to you. I will keep it safely. But sometimes, at that time, I had a feeling in 2018 that in my humble view, it was correctly priced. I valued TCS, I valued Infosys. See, the IT companies during the pandemic period, post-pandemic and pre-pandemic, the IT companies were being undervalued. At that time, I found it is happening this way. However, Reliance Industries bought back shares worth only 3,900 crores, only 38% of the target. And the stock gained 8% during the buyback period. Why do you think Reliance failed? Because it's a great business, yeah. Only fool will sell Reliance shares. Like me, once I sold, foolishly I sold. I should not have sold. I have sold a small portion of my holding. About 10% of my holding I sold. Of course, I used that money to construct a building. It went into my office building in T Nagar. But point I'm trying to make is that for that I could have borrowed and not sold my Reliance share. Is the point. Anyway, so okay, one more point of financial literacy. Recently, my son bought a new car. Okay, bought a Honda hybrid. So I was, as a gift, I told you, boss, I will fund it. He said, no, I will buy it myself. So he put some money and he agreed to repay a portion of the loan. And I said, hey, come on, I will fund a certain portion and I am funding. So my son-in-law was saying, Mama, you're having so much free cash. Why don't you put, and why take a loan? Why take a loan? Why are you borrowing? Why are you borrowing for buying this car and all? I said, look here, market is doing well now. And it's definitely going to go further. I am minimum expecting 16% return from my mutual funds. Whereas this donkey SBI is willing to give it to me at 8% or 8.5%. Why I will not borrow? Because I'm making more money with, if I remove it from mutual fund, I'm losing money now. Another example of financial literacy that good savvy people will have. For this, you don't have to be a chartered accountant, but little common sense is enough. Now, moving on, I hope things are clear. You're happy with what I'm telling. Good. And buyback of securities you have seen. Any doubts on buyback before I move on to the last topic of the day, debentures? Okay. Any doubts on buyback? Okay. Permit me to give a small break. More a biology break. Okay. Sir, can we have a small break, sir? Welcome back from a very short break. Idea was not to give you a long break, but to just give you some time to possibly go for a biology break. Maybe you may not, because after all, another half an hour, then you can as well go and have your breakfast and, whatever. No, even I will do that. So, of course, for CA students, I know because I've been a student myself, no Sunday, no holiday, nothing. This 3 years of our life, 3.5 years of our life, we have gone through torture. No time, I think you should sleep a little. Don't avoid sleeping. But food also, you have to be careful. And no outside, no movie, nothing. And that's why even when I gave my example of Mission Impossible, I was also being careful because many of you may not be able to go to movies and all. Maybe once in a while, rarely with some movie, but even that. Definitely, you cannot waste your time sitting in front of TV and, or Facebook or all the time. I'm sure you do. Sincere CA students easily spend something like 10 hours a day on studies, 10 to 12 hours a day on studies. Nearing the exam, it will go right up to 15 hours a day. But not more than that. Not more than 15 hours. If you do more than that, you will exhaust yourself. But believe me, that last 3 months, you have to set a pace of 15 hours a day. Continuous timetable, work. Yes, this is what I have found very useful. So use that 2.5 months or 2 months or 3 months very effectively. Don't plan for it and don't have any distractions and all. Don't have any distractions. Just concentrate on it. It's worth it. Think about it. 3.5 years of your life, you sacrifice. Means, during my CA, well, of course, 3 years of articleship, I completed my CA almost. My articleship got over. My CA, I qualified. Now, after 1 month after the date of my articles got over, I received my result. And I completed 21 years in January. 6 months later, I became a chartered. So I didn't become a chartered accountant before 21. I completed 21 years and then I became a CA. Within 6 months, I became a CA. And why I'm telling you all this, that 3.5 years of my life, 3 years of my life was torture. Means no movies. I was a movie buff. I used to enjoy watching movies. But during the 3 years, movies which came now, I never watched. Now only I'm watching them. Some of those movies which I missed, some of the great movies which I missed watching, because I was studying for my CA, I'm now watching. Okay, so we miss out a lot on life. Many marriages I could not attend, of cousins. My father and mother traveled all over the world with my sisters. I couldn't go for those tours because exactly exam will come. So like that. So I missed out a lot, but everything is compensated once you become a CA. Your entire life is secured after that. Believe me when I say this. 100% job assurance. No way you're going to be unemployed. Well, of course, quality of the job would determine on your communication skills, on your other things. But 100% above level job assured. For that, you have to struggle. That's all. So whenever you feel bad, whenever you feel bored, oh shit, what am I doing here? Like that, don't worry. Pass the exam, ideally final exam, first attempt, preferably with a rank. Your future is secured. Okay. So with that small suggestion, let me move on to debentures. The last topic in the share capital and debentures, section 71. Now, debenture is an instrument. Instrument means any paper. A debenture is an instrument evidencing a debt. It can be secured on the assets of the company, in which case a charge is created. So the debenture is a charge on the assets of the company. Later on, when we come to registration of charges, on 20th, I will take, when I will tell you about this. So what is a charge and all that. So sometimes debentures can be issued as collateral, as a charge on the assets of the company. Whether that's so or not, even naked debentures are possible, unsecured debentures. Whatever it is, It is a piece of paper evidencing a debt. In very crude terms, it is an IOU. That's all. In some of my physical classes, especially in the Institute of Company Secretaries of India, I would usually give this example for debentures. I will go to the class, when I'm in the class, I will tell the students, I'm going to talk about debenture today. But before I do that, I will tell them, I have a small request from you. Immediately, by then the students would become very close to me. Boliye, tell us what is it? No, you see, today I came by motorbike and it is gone. No petrol in the motorbike. Now I have to go to the petrol bunk and put petrol. And I don't have money. I forgot my purse also. So now slowly the fellows, the facial expression will change. Oh my God, we want money. Then when one or two students will start. And then I'll tell them, boss, I need money. I'm not asking for charity. You lend it to me. Tomorrow's class, I will come and give it. Don't you trust me like that? Some fellows will say, okay, sir, I will give. Others will be hesitating. And how much you need, sir? I need about 2,000 rupees. See, after all, they are all students. One single fellow cannot give 2,000 rupees. But I'll ask them, can you help me? So suddenly one student will stand up and say, sir, okay, sir, we'll give you. But how are we going to be sure that you will pay back? Now I am saying you are my intelligent student. I appreciate you. You are at with this question, that student proved that he is fit to become a company secretary chartered. So I said, okay, I will take a paper and I will write on that. I owe you whatever. So I asked that fellow, how much can you give me? Sir, I cannot give you 2,000 rupees, sir, but I can give you 20 rupees. So another student 50, another student 100. Are you able to understand what's happening here? Debentures issue is being made. So I took out 10 or 15 small pieces of paper. In each paper I wrote, I owe Mr. X 20 rupees. I owe Miss Y 40 rupees, 100 rupees, like that. Pieces of paper I have given to everybody. That money has been collected now. But now two students stand up and say, sir, don't mistake me, sir, like that. Yes, what do you want? Some collateral you have to give, sir. Agreed. Luckily, I'm wearing this Kajan watch, which is worth 6,000 rupees. Maybe the post depreciation, it is worth 3,000 rupees. I'm borrowing 2,000. So there's a good coverage. Take it. Now, who will hold that watch? Who will hold the security? 15 people have lent together 2,000 to me. Each one of them have given a piece of paper evidencing my debt. Now the charge has to be controlled. Now who will do it? So I will call two students whom everybody trusts. Usually in the class, I will take a poll. Who are the people whom you trust? Two students will emerge as the trusted people. They will become the trustees for all the debenture holders. Now we have understood. I am the company. I am borrowing. My watch is the collateral security. That is the factory, building, land, everything. The two students who collected the money gave it to me and took responsibility. To them, I hand over my watch. They become the debenture trustees who will control the security, and also the debenture trustees are responsible for collecting the debt. And of course, one day ka interest also hai na. Don't underestimate. 1 day's interest is there. I have calculated for 1 day and all. I used to lend money. So I used to calculate 1 day interest and all. Whatever it is, the interest has to be paid. All this will be monitored by the debenture trustees. Have you understood debentures now? So debenture is a piece of paper company is giving. It is secured by assets. These assets are secured in favor of the debenture trustees through a document called debenture trust deed, wherein the debenture trustees, on behalf of all the debenture holders, will take responsibility. This is how debenture. Why it's done? You see my example. One person cannot give me 2,000, but many people together can give me 2,000. And now my obligation also is reduced. Now, suppose I borrow from one bank 200 crore, the fellow will put his knife on my neck. Whereas if I borrow from a lot of public, I have to ensure that the interest is paid and everything. They will let me alone. No need to file quarterly report, and then that bank manager will come to my guest house. I have to give party to him. All that nonsense I don't have to do now. Only the debenture trustees, and these trustees would be usually big bank. The trustee also will be investment bankers or NBFCs, like they are registered with SEBI, and they will be having that knowledge of finance and all. I'll put them. So company, debenture is the instrument. The students are all debenture holders. The two students who have been selected are called debenture trustees. This is the format. It is a very good method of raising funds. And remember, this is not equity, this is debt. But debenture is also a security under the Securities Contract Regulation Act. Okay. So by issuing debentures, a company may source debt finance from the public. Debentures shall not carry voting rights, meaning in the general meeting of the company, debenture holder cannot enter. He is a creditor. Get out. But if any decision is to be taken regarding the debentures, the debenture holders can have their own meeting. That is called class meeting. Later on, when you come to management and administration, you will learn that there are three types of meetings. One, of course, board meeting, then general meeting, then class meeting. Meaning, only debenture holders will have a meeting. Only preference shareholders will have a meeting. These are all class meetings. Sometimes only secured creditors will have a meeting. That is called class meeting. Okay. So almost all the rules applicable to general meetings will apply to class meetings also. Except that here, voting will not be based on number of shares. In our creditors meeting, it will be based, in case of debenture holders meeting, it will be based on number of debentures. So if you hold 100 debentures, 100 shares. In the case of secured creditors, it will be based on value. Suppose there are 5 secured creditors, one creditor 200 crore, another 500, another 100, another 50, then votes will be in proportion to the amount due to them. Value. So whoever has more value can influence. Okay? Whatever it is. Such a meeting is called class meeting. In that meeting, the debenture holder will have a vote. But in the main general meeting, he cannot even come. He is not even invited. He cannot come. Of course, if he walks in, we will give him jangri and we will give him coffee, tea, but no talk. This is not your meeting. Keep quiet. Okay, it's like that. No votes, no voting. Now, debentures may be either convertible or non-convertible. Convertible debentures are debentures with an option to convert such debentures into shares, either wholly or in part, at the time of redemption. See, at the time of redemption, instead of getting money, they'll get shares, equity shares. Usually based on the market price of the equity share. If it's a listed company, at the time of conversion, the ratio will be fixed. Because I can't fix the ratio now. How will I know what will be the market price? See, I owe you 100 rupees per debenture. I owe you 100 rupees per debenture. Maybe I'm going to redeem the debenture at a premium, 10%. So 110 rupees I owe you. Now my share is worth 60 rupees, yeah. Or let us say, I'm going to redeem your debenture at 100 rupees debenture, premium 20 rupees, 20% premium, 120 rupees. My market price of my share today is 60 rupees, Baba. 60 rupees per share. So how many shares I have to give you? 120 is what I owe you now. If I redeem, I'll have to give you 120. Instead, I'm giving you shares. So 120 divided by market price of the share, 60 rupees. Each, if you are holding one debenture, I will give you 2 shares. Like that. I'm giving one example to help you understand. So that is called conversion. So your one debenture will be converted into 2 shares. Where debentures are wholly convertible, they are called fully convertible, FCD. See, these abbreviations are used, FCD. Where they are partly convertible, PCD. Where they are not convertible, NCD. Non-convertible debentures. Okay. Similarly, you have NCPS also. NCPS. That is non-convertible preference shares. That is also. Now, if you want to issue convertible debentures, it requires special resolution. See, one more thing, under the Ind AS and all that, convertible securities will be shown as if they are equity. Convertible shares will be shown based on the discounted value of the future conversion and all that. So on the Ind AS. So you have to be careful about the accounting part. You have to be very careful. What I'm teaching you is only the law. How this be represented in the books is very complicated, especially convertible securities. See, one humble suggestion now, if you want to become a little more expert, try to acquire expertise in IFRS and Ind AS. I tell you, that is where the world is heading. Ultimately, everything will converge into IFRS. I'm not joking. Ind AS will be there, but ultimately IFRS will be there. Whether we like or not, it will come. And we will have to comply. Either IFRS or Ind GAAP will be there, but it will be basically IFRS. So international standards would be applicable. Maybe we will call it Ind AS, Mera Bharat Mahan and all. But bottom line, the format and the rules will be the international format and not our accounting standards, the original accounting standards, Purana wala hai na, that will be thrown. And only Ind AS will survive, which is nothing but IFRS, basically. So a little bit of slowly that will be done. You're going to see that happening. You're going to see the convergence. Hopefully, you will not see the entering of CPA into India for practice. Hopefully, that shouldn't happen. But that is also on the cards. Okay, how ACPA will come in, God only knows. But they will do something. See, WTO, they were twisting our arms to make us, compliant to IFRS and all. Again, they will try. Then we are now today becoming a powerful economy. They're becoming powerful economy. In fact, again, sorry, I think Mission Impossible has influenced me a lot. That basic story is there will be one artificial intelligence. There will be a key. That key will control that entity. So that entity itself is aware of what's happening and it is trying to prevent people from controlling it. All sorts of nonsense. In that, one dialogue will come where we'll say, all the superpowers in the world are hunting for that key. In that list of superpowers, we'll have US, India, Japan, UK. 4 countries will be named. And in that list, I was very proud to hear India being named as one of the superpowers whose agency is searching for that key. So India is seen as India is slowly being seen as superpower this movie was not made by Indians. It was made in a US studio. So the US feels that India is now getting into the superpower status. I felt a little proud of my country. So, but even then, somewhere you have to merge with the international thing. So the more you delay that process, the more we are preventing ourselves from growing, is what I say. Okay. If the debentures create or constitute or create a charge, some asset belonging to the company has been offered as security. So in my example, my watch was offered as security. That means it's a secured debenture. Means a charge has been created on my watch. When a charge is created, when any asset belonging to the company is offered as security for a loan. When any asset belonging to the company is offered as security for a loan, a charge is said to be created on that asset. Later on, when we come to charge, I will again repeat this. But right now, just for your immediate knowledge, what do you mean by charge? When any asset belonging to the company is offered as a security for a loan, a charge is said to be created. So in my example, my watch was offered as a security. So those pieces of paper are secured debentures. In case no asset has been offered as a security, then they are called naked or unsecured debentures. Okay. Naked means uncovered, open. So they are called naked debentures. Issue of secured debentures is governed by Rule 18. Secured debentures shall be redeemed within 10 years from date of issue. Exception is infrastructure company. There you can go up to 30 years. Okay, redemption. But secured debentures shall be redeemed within 10 years. But if it is an infrastructure company, then 30 years. Types of debentures. You have secured debentures, which are secured, I told you, on any asset, where any asset belonging. For example, I am issuing non-convertible debentures secured on the factory land and building at Pantnagar. So the entire land, building, factory, machinery, complete setup is offered as security. Means the debentures are secured debentures having as maybe first charge against the Pantnagar factory land and building. That's all. So the debenture holders can be peacefully sleeping now, because even if the company gets into liquidation, Pantnagar land building factory will be sold now. Whatever money is realized first should be paid to these fellows. If anything is left over, only that can go to the remaining creditors. So the debenture holders become secured creditors. Okay. I'm very happy that you are learning debenture. That way the thing, because once you learn debentures, then we will get into charges. That's actually good. What you're doing is actually good. Anyway. Debentures can be secured or unsecured, or they may be convertible. Mandatorily or optionally means compulsorily convertible debenture means what? Neither have option. The company has to convert, the debenture holder has to accept the conversion. But optionally means the debenture holder will have an option. At the time of redemption, they will ask him. 2 months before redemption date, they will ask him, boss, your debentures are coming up for redemption. There is a conversion option. This is the market price of the share. So in case you convert, you will get one share for every, 10 shares for every one debenture or whatever, or 5 shares for every one debenture or whatever. In case you are interested in conversion, please fill up Form A. In case you want your money back, sign Form B, upload it. That's all. If you choose option B, your DP account, linked bank account, into that credit will come with the redemption proceedings. In case you want conversion, then within say about 15 days, based on the SEBI guidelines and all that, you will get your credit in the DP account. Those shares will be credited in your account. So you can either convert or you can redeem. Again, redemption may be partial or full. Meaning, I already told you, the entire amount may be convertible. Means 100 rupee debenture, the entire amount of 100 may be convertible, fully convertible. Or 25 may be redeemable and 75 may be convertible. You can also issue non-convertible, meaning NCD, non-convertible debentures. Means you pay interest, at the end of the period, you redeem the debenture, buy. That's all. Redeemable and irredeemable debentures. You cannot issue irredeemable debentures. Sorry. All debentures should be, except unsecured debentures can be irredeemable. Means secured debentures shall be redeemed now. Unsecured debentures may be redeemed. Okay. Now this is very important provision. The company shall create a debenture redemption reserve, DRR. Debenture redemption reserve. The company shall create a DRR out of profits available for payment of dividend. So every year you have to transfer to the DRR. DRR shall be utilized only for redemption of debentures. Means once that money is locked up in DRR, you cannot utilize it for dividend. See, in a way what you're doing, you're taking money out of the profits available for dividend, keeping it aside for repayment of redemption of debentures. DRR shall be created in respect of non-convertible portion of debenture for partly convertible debentures. So where there are partly convertible debentures, DRR should be created only for non-convertible portion. Okay, means the redeemable portion. The convertible portion, no. Now, company should create DRR like this. Actually, most of it is not required. All India financial institutions, not required. Both public issue or private placement. NBFCs, housing finance companies, other listed companies, not required. Private placement. So listed companies need not have to transfer to DRR. Unlisted companies, other than NBFCs, housing finance companies. It is a public issue, no need. Private placement only has to be, you have to provide 10% DRR. 10% of the value of outstanding debentures you have to provide every year. Every year the company should create a DRR out of profits. Idea is to set aside money for thing. So that suddenly, if you know you have to redeem the debenture, you may not. So you set aside. It's a prudent practice now. You know that you have to settle the debenture 5 years later, 6 years later. Start putting aside some money every year so that finally you are able to repay. But as of now, this 10% applies only to unlisted companies other than NBFCs and housing finance. So basically, unlisted company, that too going for a private placement. Now, in addition to DRR, every company liable to do so shall, on or before the 30th of April in each year, invest or deposit not less than 15% of the amount of its debentures maturing during the year ending 31st day of March next following in any one or more of the following methods. What does it mean? It means, once again, you are the CFO of the company. On the 1st of April, 2023, what you should have done? You should have taken out a list of debentures. You have issued many series of debentures. Find out whether any of those debentures will be maturing on or before 31st March. During the year, before 31st March 2024, will any debenture mature? Yes, one series is maturing. Then in respect of that series, you have to calculate 15% of the value. And you have to deposit it with a scheduled bank, FD. Any scheduled bank you have to keep as an FD. Or you should invest in government securities. Unencumbered means that government security should not be given as collateral. It should not be pledged. So unencumbered government securities or unencumbered securities and bonds specified in the Indian Trust Act. So unencumbered means that the above investment should not be offered as security for securing any loan. Also, the above deposit should be used only for redemption of debentures. And so you have to calculate 15%. And at any time, the above amount should not fall below 15%. So once you redeem the debentures, now again every year, on or before 30th April, you have to calculate. In case some amount is already there in the FD, you have to top it up so that it becomes 15%. At any stage, it should be 15% of the debentures maturing during the year ending on 31st March next to following. Okay. So DRR 10%, DR deposit, DRI, deposit. I don't know what DRRI you mean. What is the expansion for DRRI? This is basically amount to be deposited in bank. Idea is again prudence. See, when this come up for debenture, at least 15% of the amount is in the bank now. You will find that the same provision will be there for deposits also. Deposit redemption, deposit reserve and deposit redemption reserve and repayment reserve and deposits of the amount nature. Okay, now I will give you time to calculate and tell me. No, for unsecured debentures, there is no redemption period. Only for secured debentures, there is a redemption period of 10 years. Infrastructure company, 30 years. Unsecured debentures, you can redeem at your convenience. Basically, later on, when you come to deposits, you will understand that these unsecured debentures will become deposits. I'll tell you. When you come to deposits, you will understand that these so-called unsecured debentures will be considered as deposits, and they will be governed by the deposits rule. That is why they are letting you go here. There they will catch you. So unsecured debentures will get classified as deposits. There they will be governed by deposits rules. I can't tell you that now because I'm not teaching deposits. When you come there, I will again remind you. Don't worry about it. So tell me, what is the amount to be transferred to DRR and what is the amount to be deposited for the financial year? Hey, what happened? Darshan is coming out with an answer. DRR, 250,000. How about deposit? See, in the exam, if you're asked this question, don't write like mathematics paper, answer only. You write an elaborate explanation. You write all this. And you also make the point that ABC Limited is an unlisted public company. That is why DRR is there. If they catch you and say, and that to see, I have mentioned clearly on private placement basis. Suppose one thing is missing also, be careful. No DRR. No DRR. So, transfer to DRR, 250,000. Transfer to DRR, amount to be deposited, 3 lakhs. That is, see, you have to create DRR only on the non-convertible portion. So, out of 100 rupees, 75 is convertible. So, ignore that. Only 25 is not convertible. 25 into 1 lakh gives me 25 lakhs. On 25 lakhs, DRR 10%, 2,50,000. Bhumika is given very nicely. Whereas on 25 lakhs, 15% comes to 3,75,000 should be deposited on or before 30th of April 2021. Beautiful. I'm just giving this problem more as a concretization of your concept. I want you to be clear about the concept. That's all. Fantastic. Good. So nice. How do you get 38,250? Yeah. Madam, how do you get 38,250? I don't know if you can see the other queries. Just check out. You look at Bhumika's calculation. How do you get 38,250? I mean, I'm not able to understand your number itself, Vaishali ji. Check your number. At least give me some logic. See, Bhumika has given beautifully. She has given her logic. Also, Darshan is giving 2 lakh. No, see, nothing wrong in this query pad you can give. But when you're writing the answer, please be write elaborately. 3 lines, 1 line. So you write this paragraph. Every company shall do so. Then you write ABC Limited being an unlisted public company and these debentures being issued on private placement. The company should transfer to DRR and should also deposit money. Now you do the calculation and say amount to be deposited. Which means that if I'm giving you if I'm allotting 3 marks for this question, almost you'll get 3 on 3 or 2.5 on 3, definitely. Okay, Vaishali Bindal is not educating me on how she got 38,250. Hope she has understood how the calculation is done. 25 lakhs into 10%, 2,50,000. 25 lakhs into 15%. Because you see, these debentures are to be redeemed on September 30th now. So that means these debentures are going to be redeemed before 31st March 22. Therefore, we have to create 15%. We have to deposit 15%. Okay. I already spoke about debenture trustees. Not on, Madam Ms. Kuduri, 3,75,000 on 30th, on or before 30th April. On or before 30th April. If you want to deposit on 1st April, good. But you are having time till 30th April. Don't do it. Whenever a company issues a prospectus or makes any offer for subscription of debentures to the public or members, see, you can make an offer to the public or to your own members, where the amount is exceeding 500 in number. It shall, before issue of offer, appointed debenture trustees. Usually the debenture trustees should be registered with the SEBI, or they should be of reputation. And the duty of the debenture trustee is to protect the interest of the debenture holders and redress their grievance. debenture trustee deed not to contain any clause exempting a debenture trustee from his duties or agreeing to indemnify any loss on account of breach of duty where he fails to show degree of care and due diligence required of him. See, the minute the debenture trustees suspect that the company may become insolvent, immediately they should enforce the charge. They should file a suit for enforcing the charge. If they don't do that, they have not taken the degree of care. So they should not be in collusion with the company. No. So the company cannot also exempt them and say, hey, even if you don't do your job properly, it's okay. They will be liable to the debenture holders. Any debenture holder can file a suit against the debenture trustee for breach of trust, and claim compensation. So the role of a debenture trustee is very important. Usually there will be reputed merchant bankers or banks or NBFCs for having capital and net worth. Only they will be appointed as debenture. So they will nominate people to be the trustees on the board. So on behalf of ICICI Bank, one gentleman will be appointed as a debenture trustee who will represent ICICI Bank. Maybe 2 debenture trustees will be appointed. They will represent ICICI Bank. And ICICI Bank also might have participated in the debenture issue. They might also given money against debentures. So they will become debenture trustees. In fact, they will even promote it, syndicate it, promote it, sell it to their customers and become debenture trustees. Now, if you still feel that you need a person as a debenture trustee, but you want to exempt him from liability, then liability may be exempted provided majority of debenture holders holding 3/4 in value. Majority of debenture holders holding 3/4 in value. Meaning, if there are 1,000 debenture holders, 501 fellows should agree. And those 501 fellows should hold 3/4 in value. If they agree, then you can exempt a debenture trustee from his liability. But who will agree? Which debenture holder will agree? They simply put it there because, see, it might be like this. You might want a debenture trustee who is a reputed banker, but the banker may say, I will not come unless you exempt me. Then you can go to the debenture holders. Debenture holders also trust the company. Maybe the company is equally trustworthy. So they will say, okay, let us have him just to monitor and be in control, but we will not hold him liable for any lack of due diligence. Finally, we come to the point of redemption of debentures. So it is the duty of a company to pay interest and redeem debentures. So if they do it correctly, no problem. But if the debenture trustees come to the conclusion that the assets of the company are insufficient or are likely to become insufficient, that is, company may become insolvent to discharge the principal amount, then the debenture trustees may file a petition before the tribunal. Almost like an insolvency petition. Are you able to understand? Tribunal can only hear that petition. Then tribunal may by order impose restrictions on incurring further liabilities. Almost insolvency proceedings will start. So the company will come before the tribunal, and the tribunal will ask, what are you doing? Can you repay the debt? No, this sir, that sir. Either you pay these guys or don't take further liabilities. Stop. Okay. In case there is a failure to redeem debentures on maturity, the tribunal will apply. Okay, I mean, any or all of the debenture holders may apply, or debenture trustee may apply to the tribunal. Once the tribunal is appraised, they will direct the company to redeem the debentures forthwith. Then beg, borrow, steal, you have to redeem. Because if you don't do that, then you will be penalized. A contract with the company to take up and pay for any debentures of the company may be enforced by a decree for specific performance. That is, if a bank has entered into a contract to accept debentures, then they refuse to do it. Then you can file a suit in the court for specific performance, not compensation, not damages, specific performance. You agreed to take debentures, take it. So the court can order specific performance. Specific performance will be, the court will be hesitating to give specific performance. But here they will give. They will say, look here, you agreed to take debentures. He also believed you, went for the project. Now he is asking for the money. Take the debenture and give the money. That is your job. See, sometimes the bank will go back on their words. They will give some bullshit reason. Then the company can go to the tribunal, file a petition. Immediately the tribunal will the court. The high court will call that guy and say, here's the contract. You agreed to subscribe for debentures. Price was determined. Interest is determined. Now this guy is saying, I will allot. Take it. That's all. Once the order for specific performance is given by the High Court under the CPC, you have to comply with it. If there is any default in compliance with 71, then there is a fine of 2 lakhs. Sorry. Again, I will remove this now itself. See, in those days I kept it because some students will say, sir, in the institute material it is there, sir, like that. For that those people only. Now it's very clear. Institute material is also updated. So there is no penalty by way of imprisonment, only fine, 2 lakhs to 5 lakhs. Fantastic. You know what? The time is exactly 9:29 and I have come to the end of my topics, share capital debentures. What I will do, inshallah, today I will upload the notes. Also, I will upload the assignment. Our next class will be on the 20th of July. 18th of July, I am going to Coimbatore again, and I am addressing a group of entrepreneurs on accounting and finance. So I am so sorry, on that day I will not be able to take. Luckily for us, we could complete the 2 topics well within the time allotted. So 18th class, I am supposed to take share capital debenture. I have finished share capital debenture today. So I will be 18th, I will not be having a class. Next class will be on 20th, when inshallah we will take up registration of charges. Maybe I might work out the assignment that I am giving also. Or if time permits, at the fag end of July, the last class of July, I will cover the assignments also. Okay? Great. Thank you very much. Have a great day. Have a great Sunday. Enjoy yourself. Bye.